Can a normal middle class family really build a $1 million portfolio in 20 years? I know the internet is full of hype and get rich quick promises. But today, let's cut through the noise, do the actual maths, and show you practical steps based on real data that can actually close the gap between dream and reality for you. Firstly, a quick disclaimer. I'm not a financial advisor, and this isn't personalized financial advice. So why should you even listen to this silver-haired bloke like me? Well, I'm not your 20-something popular financial influencer trying to sell you a course. What I've instead done is spent 25 years as a civil engineer, as a global professional, handling multi-million-dollar projects and budgets and driving efficiencies in organizations that I work with. This is in my professional life, but I also have experience of living in 4 countries across the world, in India, across the Middle East, and in the UK. Along the way, I've also studied money and personal finance very deeply, which means I've made my share of mistakes, I've lost money, and I've learned lessons the hard way. What I share with you today is not textbook theory. These are real-world strategies that I wish someone had taught my younger self 20 years ago. In today's video, I will be using the United States dollar as a currency because it is global, but you can easily replace it with your own currency. Feel free to use pounds or rupees or euros or reals. The maths and the principles remain exactly the same. So for many of you, the goal of accumulating a $1 million investment corpus might feel like a fantasy, especially if you're a middle-class working professional. But I want to change your perspective today. This isn't about luck, it's not about timing, and it's not about some secret formula. It's just about boring process, discipline, and leverage. If you rely only on your salary, $1 million can remain a dream. But if you rely on the right processes, systems, and maths, this can become a mathematical certainty within 15 to 20 years. Today, we are going to build this plan on 6 foundational steps. Each one of them is necessary, but the power actually comes from combining all of them. So we start with protection, then we move to automation, and finally, the acceleration phase. So let's first begin with the shield. Setting your $1 million foundation. So first protect before you grow. Now, we all know that we can't win a race if we are constantly falling. But before you even chase returns, you must protect yourself, protect the downsides. 2 things that you must absolutely keep in place before you invest your first dollar. First is health insurance. This can actually be a poverty stopper. The data here is stark as well. According to the World Health Organization, over 1.3 billion people face financial hardship every year, and almost 350 million people are globally being dragged into extreme poverty due to high out-of-pocket health costs. Just one hospital bill for yourself or a family member can wipe out years, sometimes even decades of careful savings. Therefore, first ensure that you have a solid health coverage plan. Either private or public, that doesn't matter. It needs to fit yours and your family's needs. This is the single most important hedge against financial ruin. And secondly, the emergency fund, the cash buffer that I mentioned to you in previous videos as well. Your emergency fund is the essential moat around your investment portfolio. Aim for at least 6 months of essential living expenses. Now, this will cover you if you lose a job, face a sudden home repair, or need an unexpected flight home. This fund protects you from having to sell your investments, especially when the markets are down. But here's the critical piece of advice, my friends. Don't just let your funds sit idle. Your funds should be a mix of immediate access funds in high yield savings account for about 1 to 2 months worth of expenses. And you have it in quick access money market funds or short-term treasuries for the remaining balance. Now, these offer better returns than traditional savings account, as you know, and maintains near perfect liquidity. The point isn't just about having the money. It's about having access to the money quickly enough without disrupting your long-term growth assets. Now, the second step is what I call fueling the compounding engine. Automate your investments in many global markets. It simply means investing a fixed amount of money at fixed intervals. Let's look at the baseline maths behind this. Assuming a historically conservative 8% annual return, which is realistic for a globally diversified portfolio over decades, if you consistently invest $500 every month, in 20 years, you'll accumulate approximately $275,000. Now, if you step it up a notch, up to $1,000 a month, your corpus becomes over $600,000. That's the power of compounding. You've invested only $240,000 and it has grown to over $600,000. Your money actually made more money than you put in. But let's pause for a reality check. This alone is not enough to get you to your $1 million unless you have a higher starting point or you have a longer 25 or 30-year timeline. We just need to do more than just be consistent. We need to try and accelerate. And that's what in step 3 I called step up investing, which is leveraging your raises. Now, the single most important and easiest adjustment for any middle class working professional is stepping up their investments. Most people get an annual salary raise or a promotion. And what do? They increase their spending. This is called lifestyle inflation. The key to building wealth, my friends, is to invest at least a part of the raise, not just spend it all. If you increase your investment, even by a small percentage every year, the numbers absolutely explode. Now, let's look at it with an example. Assume the same $500 a month start and 8% returns over 20 years. In scenario A, assuming you have a flat investment profile, you will end up at $275,000 to $300,000 at the end of 20 years. Scenario B is stepping up your investments by just 10% every year based on your annual rises, increments, promotions, etc. And it cranks up your final number to over $700,000. Now, this is a difference of almost $400,000. Now, this is how middle class families can realistically accelerate the wealth without feeling the pinch in year one. Your spending habits are low when you start, and your investment grows in line with your earning power, almost invisibly. The next step can actually change the game if you can add a side income stream to bridge the gap to $1 million. The fact is, we need to inject more capital. Your primary job will cover your living expenses and your core investments that we spoke about in step 3. A side income stream is purely dedicated to wealth acceleration. Even a modest side hustle that adds about $500 a month, invested consistently at 8%, grows to nearly $300,000 in 20 years. Add that to what you have from step 3, and you're well over 1 million. But the mention of a side hustle makes many of us uncomfortable. But here's the truth. Every single one of us has a monetizable skill. You just may not see it yet because you think your skills are quite mainstream. But what's common to you is valuable to somebody else. You can consider tutoring or coaching in subjects such as maths, coding, music, or even foreign languages to students globally via Zoom. You can take up some freelancing opportunities, leveraging your professional skills like writing, design, video editing, or data analysis on platforms such as Upwork or Fiverr. You can even consider local services like babysitting, pet care, delivery, or handyman tasks, which are small services that pay quick, tangible cash amounts. And you may also leverage your digital skills through social media management for local businesses, content creation, or simple website maintenance. If you have professional knowledge, then you can take consulting calls or mentoring in your area of corporate expertise. Even $100 to $200 a month can make a huge difference. But aiming for about $500 or more truly changes the game and secures your $1 million target fairly quickly. The next step is the investment strategy and discipline. Now that we know how much to invest, let's talk about where. The best investing is usually the most boring, diversified, and low-cost investing. Don't chase fads or stock tips. The global equity market, MSCI World Index, has historically returned 10.38% annually over the past 46 years. Now, that's where our conservative 8% figure in our calculations comes from. A practical, simple, and resilient asset allocation over a 15 to 20-year timeline is simple global diversified equity index funds, or ETFs. These track the global stock markets. These are low-cost funds which give you exposure to thousands of companies worldwide, maximizing your growth potential while minimizing the risk of any single company failing. Of course, like I've mentioned in previous videos, depending on the stage of life you are in, You can either adopt an aggressive approach, a balanced approach, or a safe approach to investments. I've explained these approaches in this video if you haven't watched it yet. A quick note for you, my friends. The best vehicle for this allocation will typically be a tax-advantaged retirement account, like the 401k in the US, ISAs or SIPs in the UK, NPS, or a simple brokerage account in the country where you have tax residency. If you're unsure of this, seek professional advice on optimizing the tax efficiency based on your specific location. And finally, step 6 is the behavior and mindset, which can be the absolute deciding factor. The maths will get you to the goal, but the psychology is what determines whether you will stick to the plan. Over 15 to 20 years, your biggest enemy won't be the market. It will most likely be yourself. So, avoid lifestyle creep. If your salary goes up 10%, your spending should only go up by 5% or less. Invest the difference. This is the single biggest secret to building wealth fast. If you maintain a middle class lifestyle while earning an upper middle class salary, you will definitely get rich. Next, try and automate everything. Make your investment invisible. Set up scheduled deductions from your paycheck or bank account the day you get paid. You can't spend money that you never see. Also, automation enforces the discipline and eliminates emotional decision making. Next, stay the course. Over the next 20 years, markets will crash. We know this for a fact. You will see your portfolio value going down by 20%, 30%, maybe even 50%. Now, this is where most people fail. Historically, markets have always recovered and gone higher. When the crash happens, do nothing. Or better yet, if you have the opportunity, see it as a sale and continue buying or even increase your automated investments. Follow these steps, and the $1 million corpus stops being a dream. It becomes a mathematical certainty. The system is built. Now it's time for you to take step 1 and start protecting your downside if you haven't done so already. Your financial journey doesn't have to be a lonely one. A big part of staying disciplined is having a community. So my question for you is this: what's the one financial mistake from your past that has taught you the most? Share your lessons in the comments below. Let's learn from each other's experiences and build a stronger foundation for our collective future. If you found this video interesting, don't forget to like, subscribe, and if you haven't already, share with someone you care about. I'll see you in the next one, my friends.